Hello value investors, thank you for joining me. Today we're going to talk about Elastic. So we're going to talk about what Elastic does, we're going to talk about its financials, we're going to unpick its guidance, then we're going to talk about one of the blemishes that I find in its guidance, and we're going to bring that all together by talking about its valuation. If you haven't done so already, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you what stocks I own and what's attractive to me right now. So, Elastic is a search company, okay? So if you think about the amount of data that's really come out in the last several years, you can see that the company is growing its TAM quite aggressively. So because of a rapidly growing TAM, it's not alone in this space. There's a lot of competition in this space. You have bigger players like Amazon's AWS. You have a very close peer, the very aggressive peer, Datadog, and you have quite a lot of startups. So there is a lot of, the TAM is expanding, and the demand for companies to be able to search data and to get actionable insights is obviously it's a real tailwind for Elastic. Having said that, if the company's growth rates are starting to kind of taper off, having an expanding TAM might not be the be and end all. So for example, if you look for the guidance for this upcoming quarter, Q1 2022, because their fiscal years are misaligned, is pointing towards approximately 34% year-over-year increase. That compares with 44% in the same time last year. So there's 1,000 basis points deceleration year-over-year. So this is a company, yes, the TAM is expanding, but it's coming up against a bit of a wall there. Is it down to the sales and marketing team, or is it down to the product? There's just too much competition out there. It's difficult to say, but it's just something to keep in mind. Having said that, if you think about this time next year, the company is going to be on a run rate of very close to about 850 million. So it's coming close to that $1 billion market cap. So as the company expands to a certain size, it's obviously going to start slowing down. However, if the company is expected to grow at 30% as well, still very attractive. To be growing at close to approximately $1 billion, like definitely within the next 18 months, it'll be on a run rate of $1 billion in revenues. For it to be growing close to 30%, that's quite attractive in the SaaS space. So if you remember, 93% of their revenues are recurring. So it has a very sticky customer base. On the other hand, one of the things that I came up when I looked at this company is that its operating margins have been progressing in the right way. So it was at negative 21% in fiscal 19, then it moved towards mid-teens negative, and it finished fiscal 21 at negative 1%. So it's very, very close to break even. However, as it looks out to the next year, its operating margins are going to come up about negative 4.5% at the high end. So it's just taking a step back again. The company says that it's investing in its growth rate, it's building out its sales team. So you have this kind of slowing growth rates, and you're having the path to profitability again taking a step back. So it is kind of getting close to break even, but it was still about probably 2 years away until the company starts breaking even. So these two things combined is kind of like doesn't leave a lot for any investor to get particularly bullish on. However, having said that, it is quite attractively priced. So if you compare with the database company MongoDB, that company is growing at very similar. The guidance is quite similar to Elastic, but that company trades at 25 times forward sales. So it's obviously a premium to the 15 times forward sales that Elastic trades at. On the other hand, you have Datadog. Datadog's share price hasn't really gone very far in the last 12 months, but that company still trades at 42 times forward sales. There's not so many companies out there right now in the SaaS world. After that hit since February that a lot of these high growth companies have taken, there's not many companies out there left trading at such a high multiple. Obviously CrowdStrike is approximately 35 times forward sales, but in the SaaS space, I mean, this is really, 42 is really punchy. So in comparison with that, Elastic is quite cheap at 15 times forward sales. Having said that, Datadog is one of the few companies that's growing at more than 45% year over year on this guidance. So it's been a fantastic company. It's been just putting out guidance, consistently beating it and raising their guidance. So, I mean, it is a large multiple, but it is growing quite fast. So, I mean, that's the kind of level that you should be thinking about. And when you look at Elastic, obviously Elastic is growing slightly slower, but the valuation is dramatically lower too. So, I think that all in all, it's quite an attractive play, and it's something that you worthwhile considering, at least keeping on your watch list. That's what I'm going to do. But if you want to know which stocks I'm actually buying, let me know and come on to Deep Value Returns. I'll tell you the stocks I own and chat with you. See you soon. Bye.